Is Lighter going to be the next perpetual DEX to take off like Aster did or Avantis? Well, that's yet to be seen, but the founder just dropped major alpha in an interview. Here's what you missed. Most people have already heard the hype about Lighter, but few know the real story behind it. The decentralized perpetual DEX that could rival MYX, Avantis, and Aster, projects in the perpetual DEX space that have been catching some serious gains in the crypto space. Now, on Corey Hoffstein's Flirting with Models podcast, Lighter's founder, Vlad Novakovski, hopefully I say all those names right, shared details about the tech liquidity risk and the vision that you won't find on the website. Today, I'm going to break down some of the most important gems from that interview and why Lighter could be one of the most serious challengers in this space. And the token is not out yet. Information is scarce. Real quick before we hop into the interview, let's talk about Corey, who's doing the interview. Now, he is a chief investment officer of Newfound Research, also one of the sharpest voices in quantitative investing. His podcast, Flirting with Models, has over 100 episodes and a 4.9 out of 5 rating, and is widely respected in the traditional finance and quant circles. So when we say quant, we mean quantum. And quantum investing more specifically. And the real takeaway here is he is widely respected in traditional finance, right? So when Corey brings on Vlad Novakovski, the founder of Lighter, to talk, that's a big deal. This isn't just another hype video done by some kind of crypto influencer. It's a signal that serious researchers are paying attention to Lighter. So who is building Lighter, right? Vlad Novakovski isn't just another DeFi founder. He really sharpened his skills at Citadel, early high-frequency trading desk, and then built another high-frequency trading business inside another hedge fund. Later moved to Silicon Valley and started working for an AI plus fintech startup. In 2022, he pivoted his team away from AI to crypto with backing from supportive investors. That pivot was driven by one simple question: why are decentralized assets still traded on centralized exchanges? Which is a great question. Every great product should solve a problem, right? So what problem is Lighter trying to solve? Well, 99% of crypto assets were traded centrally. FTX collapse really proved the risk in this space. Vlad's mission became to build an exchange with the speed of centralized trading, but with an on-chain transparency and verifiability. Think of a centralized exchange performance mixed with the DeFi security. Now, instead of another automated market maker, Lighter is an order-based, perpetual decentralized exchange designed for high-frequency trading, low latency, and self-custody. The self-custody aspect, I think, is really big, and we will come back to that in a minute. If you saw my previous video, we refer to it as the exit hatch. Lighter's technical edge, built as a custom Ethereum Layer-2, it uses zero-knowledge circuits, but not for privacy, but for succinct proofs that compress thousands of trades into one short proof. Escape hatch that we mentioned earlier is if the sequencer fails, funds can be withdrawn directly from Ethereum Layer-1. Think if FTX had this structure, everybody would have been able to withdraw their funds from the exchange, and the whole narrative around it would be totally different. Now, this isn't an experimental design. It took them 18 months to solve the hard problems, first like scalable data structures to prevent state growth bottlenecks, and key innovations are their custom tree structures that both store order books and generate Merkle proofs efficiently. And pools. Lighter uses liquidity provider pool LLP model similar to GMX or Hyperliquid, but unlike others, the protocol team seeded it with just $100,000, and the community grew it past 100 million total value locked organically. There's a very good distinction there. They're adding XLP, which is experimental liquidity pools, for riskier markets like pre-launch coins plus RWAs, keeping core liquidity safe. Now, one gem from this interview is that Vlad admitted early on Lighter was manipulated when liquidity was deeper on smaller perps than Binance Spot, but they made the LPs whole and rebuilt the model. So you don't have to worry about that anymore. Right now, LLP still supplies 80% of the liquidity, but with 40 to 50 market makers on board, that dominance will shrink, pushing Lighter closer to professional market depth. So the business model: no fees for retail traders. Pros, like high-frequency traders, pay for premium access plus latency. This is inspired by Robinhood's model, and Corey Hoffstein was an early advisor over there. So Vlad's logic: retail is the lifeblood, so make it free. Pros will always show up if there's money to be made. Security, risk, and a reality check. Some critics say Lighter isn't fully decentralized because it has a private sequencer, but keep in mind, no decentralized sequencer really exists. And Vlad's response: decentralization isn't the goal, verifiability is. ZK proofs means it doesn't really matter who runs the sequencer. If the math doesn't check out, Ethereum will reject it. If compromised, users can always use the escape hatch back to the layer 1, which is Ethereum. Audits, bug catchers, and private beta and live trading are already battle tested the system. So is Lighter the next MYX, Aster, or Avantis? Well, it might be. But with serious high-frequency trader talent, 100 million plus organic liquidity, and battle-tested ZK rollup design, Lighter is positioning itself as the backbone for on-chain trading. But remember, this isn't financial advice. Always do your own research. And if you found this breakdown useful, hit that like, subscribe, and let me know down in the comments, are you bullish on Lighter? Now, we do go deep dive research Monday through Friday, 8 p.m. New York time. Come check it out and raise your crypto IQ with us. Join the community.